Welcome to SS2 Economics, Term 2, Week 1. Today we study monetary policy, the use of money supply and interest rates to manage aggregate demand, control inflation, and support economic growth. Monetary policy is managed by the Central Bank of Nigeria, CBN, and is one of the two main tools of macroeconomic management alongside fiscal policy. The CBN was established by the Central Bank of Nigeria Act 1958 and has the mandate to maintain monetary and price stability, promote a sound financial system, and support the economic policy of the federal government. Understanding monetary policy helps us understand why the CBN raises or lowers interest rates, why the naira exchange rate changes, and how banks create money. Money is anything that is generally accepted as a medium of exchange, a store of value, and a unit of account. The money supply has several definitions depending on how broadly we count money like assets. M1, narrow money, includes currency in circulation, banknotes and coins outside banks, plus current account deposits in commercial banks. M2, broad money, includes M1 plus savings deposits and time deposits. M3 includes M2 plus large time deposits and money market funds. The total money supply in Nigeria is measured and monitored by the CBN. Money matters for macroeconomics through the quantity theory of money, M times V equals P times Y, where M is money supply, V is velocity of circulation, how many times each naira is spent per year, P is the price level, and Y is real output. If V and Y are constant, doubling M doubles P, prices double. This simple relationship explains why excessive money creation causes inflation. In Nigeria, periods of rapid money supply expansion, such as deficit financing by the government, when the CBN prints naira to cover budget shortfalls, have been associated with high inflation. The CBN uses several instruments to manage the money supply and interest rates. The monetary policy rate, MPR, is the benchmark interest rate set by the CBN. It is the rate at which the CBN lends to commercial banks overnight. When the CBN raises the MPR, bank lending rates rise, borrowing becomes more expensive, aggregate demand falls, and inflation is controlled. When the CBN lowers the MPR, borrowing becomes cheaper, investment and consumption rise, and aggregate demand expands. In 2023 and 2024, the CBN raised the MPR aggressively, from around 11.5% to 27.5% to combat inflation, which reached 30% in 2024. Open market operations, OMO, involves the CBN buying or selling government securities, treasury bills, in the financial market. Selling T-bills absorbs naira from the banking system, reducing money supply. Buying T-bills injects naira, increasing money supply. The cash reserve ratio, CR, is the minimum proportion of deposits that commercial banks must hold as reserves with the CBN. A higher CR means banks can lend less, reducing money supply. A lower CR allows more lending. In 2024, the CR in Nigeria was 45%, among the highest in the world, as the CBN tried to absorb excess liquidity. The liquidity ratio is the minimum proportion of assets that banks must hold in liquid form. Special deposits and moral suasion are additional tools. Like fiscal policy, monetary policy can be expansionary or contractionary. Expansionary monetary policy is used during a recession to stimulate the economy. The CBN lowers the MPR, interest rates fall, reduces the CR, banks can lend more, or buys government securities through OMO, injecting money. Lower interest rates encourage investment and consumption, raising aggregate demand and national income. Contractionary monetary policy is used during inflation to reduce aggregate demand. The CBN raises the MPR, interest rates rise, increases the CR, banks hold more reserves, lend less, or sells government securities through OMO, withdrawing money. Higher interest rates discourage borrowing and spending, reducing aggregate demand and slowing inflation. The transmission mechanism of monetary policy describes how monetary policy affects the economy through several channels: the interest rate channel, as described, the exchange rate channel. Higher interest rates attract foreign capital, appreciating the exchange rate and reducing import prices. The asset price channel, lower interest rates raise asset prices, increasing wealth and consumption. And the credit channel, lower rates encourage banks to lend more. Nigeria faces distinctive monetary policy challenges. First, a dual economy. Rural areas with low banking penetration mean monetary policy transmission is weak. CBN interest rate changes do not immediately affect the large informal sector. Second, currency and exchange rate issues. The CBN has historically managed the naira exchange rate, but maintaining a managed exchange rate can conflict with domestic monetary objectives. The 2023 exchange rate unification, moving from a multiple exchange rate system to a unified floating rate, was a major policy shift. Third, fiscal dominance. When the government runs large deficits and asks the CBN to finance them, ways and means advances, money supply expands, fueling inflation regardless of monetary policy stance. The CBN's independence is therefore compromised by fiscal pressures. Fourth, high inflation. Nigeria's inflation rate has been persistently high, reaching 30% in 2024, driven by supply-side factors, infrastructure deficits, import costs, fuel price increases, that monetary policy alone cannot address. Fifth, financial system debt. Nigeria's financial sector is growing but still relatively shallow. The ratio of private sector credit to GDP remains low compared to peer economies, meaning monetary policy has limited traction. To summarize, monetary policy is managed by the CBN using instruments including the monetary policy rate, MPR, open market operations, OMO, cash reserve ratio, CR, and liquidity ratio. Money supply definitions, M1 and currency plus current accounts, M2 where M1 plus savings and time deposits. Quantity theory, MV equals PY, excessive money creation causes inflation. Expansionary monetary policy, lower MPR, lower CR, by securities, stimulates the economy. Contractionary policy, higher MPR, higher CR, sells securities, fights inflation. The transmission mechanism works through interest rates, exchange rates, asset prices, and credit channels. Nigeria's monetary policy challenges include fiscal dominance, weak transmission, high inflation, exchange rate management, and limited financial debt. For WAEC, define monetary policy, name and explain the instruments, distinguish expansionary and contractionary policy, explain the quantity theory of money, and outline the challenges of monetary policy in Nigeria.